but because of the functioning of the monetary system, debt must grow exponentially, and has been ever since 1971. So yes, we have record new levels of debt. Every time you interview me, anytime anybody interviews me, the debt is always at a new record. It's growing exponentially. That's what an exponential curve is. So the problem with exponential growth curves, if you look around at the engineering world or the natural world, you find that they don't end well.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products or services. Always do your due diligence and consult with your financial advisor. My guest today is Keith Weiner, an American economist, entrepreneur, and advocate for gold standard. He is the founder and CEO of Monetary Metals. Keith, welcome back to the show. It is great to have you back.
Thanks for having me back.
Yeah, our last interview was a pretty good interview with excellent feedback, so I hope we will repeat that today. I want to start maybe with the monetary policy and economic instability as a topic. In 2025, in this year, the inflation has, let's say, moderated in some areas, but the debt levels continue to climb globally. How do you assess the current state of the fiat money system, and what risks do you see in the near term?
How do I assess the fiat money system? Boy, is that a
Huge question.
Topic and a half. I've been saying for many years, and even the free banking economists and free market economists find some of my views controversial, but I'll say them anyway. And the first is that, so fiat refers to government force. The government says, use this as money, or use this as if it were money, because they can't change reality, but they can force you to act as if reality were different. Because they have a gun that's bigger than anyone else's gun. But more importantly, in an economic context, the currency is irredeemable. So in a free market, in a normal world, which we do not have, the money is gold. And, they're issued pieces of paper, which are very useful for a number of reasons, that are redeemable in gold. So in the United States, up until 1933, you could deposit an ounce of gold in a bank, approximately an ounce, it was just under, and get a $20 bill. Redeem at any time, either you yourself or you paid that $20 bill to somebody else. You can walk into the bank, no questions asked, and just put the $20 bill across the counter to the teller, and the teller would give you back the gold. So that's redeemability. The most important feature of that is it keeps them honest. Most of the people, most of the time, have no need to redeem. It's only when either they're cheating in terms of the quality of the credit they're issuing, or someone's trying to put their thumb on the scale and the interest rate is dropped below your time preference, and you say, it's not worth it anymore for this, this set of risks in this banking system. I might as well take my gold back. Well, that's what they ended different countries at different times. The United States infamously in 1933 with the edict by President Roosevelt. And then after that, everybody's disenfranchised. No matter what they do, you can withdraw your cash. People think of it as withdrawing from the bank, and you get paper, right? And the paper itself is a credit, and it says right on it, Federal Reserve note. And note is a word for credit. So you can either finance the banking system by having a banking deposit, or you can finance the Federal Reserve, who uses it to finance the government and the banking system. Or you can buy treasury bonds or treasury bills, which finance, the government and the banking system. You can't really get out anymore. You're disenfranchised. So this allows them to play whatever game they want and make the money, or what they call money, the currency, more and more dishonest. And so what we have is a crisis of honesty. Credit is borrowing, but if you're borrowing without the means or intent to repay, it's a fraud, it's a counterfeiting. And so that's sort of the root of the whole system. So the two problems in irredeemable currency economically that sort of ensue, one is because we pay debts using dollars or euros, and those are themselves IOUs, we pay debts using IOUs. Notice the problem, the IOU, the debt itself is never extinguished. It's merely shifted around like a lump under the rug, which means necessarily, as an inexorable, necessary part of the functioning of the system. Not because the politicians are bad, which they are, not because the voters want more free goodies, which they do, but because of the functioning of the monetary system, debt must grow exponentially, and has been ever since 1971. So yes, we have record new levels of debt. Every time you interview me, anytime anybody interviews me, the debt is always at a new record. It's growing exponentially. That's what an exponential curve is. So the problem with exponential growth curves, if you look around at the engineering world or the natural world, you find that they don't end well. They end not gracefully. They don't subside gently. They don't go, gently into this good night. They fail in a catastrophic, blow up. Think of a thermonuclear bomb, going off. It's that kind of thing. When that happens is anybody's guess. If you asked me in 2012, I would have said 5 to 7 years. Obviously, I was early, quite early. Here we are in 2025, 13 years later, and apparently still going strong. But there is a finite, terminus to all of this. So the debt grows exponentially. That is a necessary function of the whole thing. And the other is that the interest rate is totally unhinged. After World War II, most infamously, the interest rate was ever rising. By the 1970s, they called government bonds were called certificates of confiscation for the virtually guaranteed and endless capital losses. As every time the interest rate rises, a long-term bond, it loses, value in the market. And then, finally hitting an absurd peak by 1980, 1981, and then reversing almost to the day that President Reagan took office. And so he gets credit as being a brilliant, economic president. It's great fun to be president when long-term rising interest rate turns to a falling interest rate that juices up one hell of a boom, as economists call it, a boom. It's not a good thing, but it was a lot of fun at the time. And we're still in a falling interest rate trend now. Other central banks have begun to cut. The Fed had started. But of course, we have a president who is now ordering the Fed, you will cut. So the chairman of the Fed, Jay Powell, seems to resent that and is resisting that and saying, no, we have this indicator and that indicator and this but that, yes but no, on the one hand, on the other hand. And so, he's dithering. I assume, this is not economic science, this is just reading people. People resent being told what to do. He doesn't think, and most people don't think the president rightfully has the power to dictate interest rate policy. That's not how our particular central planning system was set up. That particular power is supposed to be in the hands of the Federal Reserve Board, not the presidency. But I'll say two things. One, Powell's term is coming to an end, I believe next year. And number two, the forces that have been driving the interest rate down since 1981 are still in full force and effect. And so one way or the other, interest rates are going to come down. In the meantime, the perversity of the whole thing, mainstream theory thinks if you want to fight rising consumer prices, which they miscall inflation, then you should hike interest rates. That is exactly the opposite of what you should do. There are many, many harmful effects of falling interest rates. But if your only care was consumer prices, you should want falling interest rates because that means fresh, new, every time the interest rate ticks down is an additional incentive for every producer to borrow more to finance more productive capacity. And conversely, every time the interest rate rises, that renders some productive asset submarginal. It has to be liquidated. And we're in that phase now, as you see, companies failing, trying to, divest of assets. Ultimately, assets are going to have to get shut down. And so if you want higher prices, have higher interest rates, because corporate, return on capital is driven by, the interest rate. You can't have a return on capital below the cost of capital. And so, with return on capital, comes margins. Margins ultimately reflected in prices. So we are seeing, have seen an uptick in prices due to that, and of course due to, everything from COVID, lockdown and whiplash, to green energy policies that have made energy, in the UK about 10x more expensive what it was. I don't have
Yeah.
the exact prices in Germany, but a lot higher, right? Um, and then tariffs, which are driving prices higher, but with a variable lag.
Yeah, let's stick to interest rates. With recent rates adjustments by central banks, how do you see real interest rate trending in 2026, let's say, and what implication does it have for savers and investors?
Well, I think just in general, central banks of the world and the commercial banks have been in collusion on a war on interest, and basically they've won. Unlike the war on drugs, the war on poverty, the war on terror, there's lots of wars, fake wars they declare, which they never win. In the case of the undeclared war on interest, it's all over but the shouting. And so if you're a saver and you're holding this fiat irredeemable currency, the problem is, there isn't real interest anymore. Yes, there's a blip right now, and you can get a little bit, regardless of whether the currency is falling in value, which of course it is designed to do, and the central banks openly say that they define their goal as price stability, right? But Orwell would be proud, or maybe rolling over in his grave, depending on how you look at it, that price stability is defined as relentless 2% inflation forever. That's price stability, and nobody questions this like anything else. But um, regardless of whether the currency is losing its value, you're not getting much, if any, interest in a bank account, and so that has enormous implications. We wonder, why aren't people starting families and having kids? Well, they can't save for their future, and they can't save for their retirement goals either. A shocking number of people have no meaningful, savings for retirement, and they just kind of shrug and say, "Well, the government retirement scheme, will cover it." But the government retirement scheme isn't able to invest and get a return either. They just figure, well, we'll tax the next generation. Except there isn't much of a next generation, or the next generation is smaller because of all the other, forces, and so all these things are grinding towards some inexorable terminus, as all these different social issues, are going to collide probably at the same time. Um, but I only foresee falling interest rates, which means capital gains, right, on assets, and people use capital gains on assets as a surrogate for earning yield. Economically, it's the opposite, but that's the world. And so, yeah, savers are, as we say in America, they get hosed, in this kind of environment.
Yeah, Keith, spot on. Let's move to gold and silver. What factors do you see shaping the gold and silver markets in the coming months?
I continue to see endless drivers for people to buy gold. And if one country is buying a bit less, say Turkey, right now premiums have subsided somewhat within the country. It's still a premium market, but not as much as it had been. Demand picks up elsewhere. If retail, let's say in the United States, hasn't been buying, we see greater and greater institutional interest. Of course, gold has always been that kind of market that every different possible group, from Indian workers making a wage of $5 a day, to Wall Street giants, everybody is a buyer or seller under the right conditions and at the right prices. But in general, I see nothing good happening in the world of currencies or government finances, which is what the currencies are issued ultimately to do. So, unlike, say, 2009, when everyone didn't understand QE and said hyperinflation is imminent. I was at a conference in July of 2009, and somebody, a big famous name, who I'm not going to say who it is, said that hyperinflation is certain by the end of the year, 2009, 16 years ago. So anyways, people were buying gold to protect themselves from something that wasn't going to happen. And I said at the time, this is not going to end well, because when it doesn't happen, then there'll be a lot of selling, and of course there was. And so we went into this endless, seemingly endless bear market, second half of 2011 through 2018 into 2019. But today, I think the buying is different. It's just, I think, a much greater sense that gold is a long-term holding. I mean, obviously, a lot of people use it as a speculation. You buy it, the price goes up, you sell it, you have a gain, great, whatever. But I think there are more and more people that are buying it without any particular price expectation and no particular time horizon to sell it, which is important. First of all, that's the right thing to do, because you're protecting yourself against government credit dishonesty. Whether the price of the dollar will be this or that. But it's important in discussing the gold market that these are durable, I guess what they call strong hands, people that are buying it without any particular intention to sell it. And so this is a market where you buy the dips. And you look back, last year I was in Dubai. It was around August. Very, very hot. Not a lot of people want to be there by choice. And I was wandering around the gold souk, which was fairly empty. And there were several stores that had a sign, 0% making charge. So I'm like, okay, is this real? Is this some sort of come on? If this was Canal Street in New York, there's stores that are perpetually going out of business for 30. I mean, the sign that says going out of business is yellowed and frayed, and that sign's been in the window for 20 years, right? So I go in, and I see the price of something. It was a necklace that weighed 89.5 grams. This thing was heavy. I mean, I pity anybody who actually tries to wear it. By the end of the day, you'd have this bloody welt on your neck. And I regret not buying it. Of course, the gold price was, at that time, what was it? I don't know, 300? Something like that. And, a heck of a lot higher now. Maybe it was 24, 2,500 at that point. And it was true. It was a 0% making charge. And the reason is the jewelers are borrowing dollars to buy their inventory, which means they have to hedge, which means they have to short gold in the futures market. And when the price goes up, then they have a margin call. And so they have to liquidate some inventory, and that's what was driving this. Anyways, my point is I regret not buying it. It was truly a 0% making charge. There's a 5% VAT. So you could buy a piece of perfectly nice jewelry for 5% over the then spot price. Spot price has moved up quite a lot since then. And here I am regretting I should have bought that.
Yeah, good story. Keith, with global currencies and central bank digital currencies gaining attention in this year and prior, of course, how do you position gold in contrast to these emerging systems, particularly in the terms of sound money principles?
Well, the central bank digital currencies are largely the same thing as the old currencies with a snazzy new form. It does allow arguably greater powers of them to snoop on what you're doing, greater powers to dictate what you can and can't do. Oh, you've used up your carbon credits, for the month, sir. Kind of like, ration coupons in the Soviet Union. They can control how much you can buy of this and that and the other thing. I think they largely have that control over the banking system and the credit cards anyways. So I think that's incremental. More importantly, when interest rates go negative again, they're going to want this in place before then. And then what people are going to discover is that they're trapped. See, if you can withdraw paper cash, there is one benefit to that versus a bank deposit. If the bank deposit is paying, let's say, negative 75 basis points, which that was true in Switzerland, before interest rate hikes, you can withdraw paper cash and get zero. And so if interest rates in banks become negative enough, people withdraw paper. So they have to herd everybody into some sort of digital token before that point. And that way, when that happens, then they can program those digital tokens to have the same loss at the same rate. So if the bank's deposits are minus 75, then the digital tokens will be programmed to lose value at the same rate. And there will be no escape. Obviously, if you own gold, they can't do that. So I'd say gold will give greater privacy, but more importantly, already gold is immune from the ravages of zero negative interest rates, and then in this regime, it becomes a more important point than ever before.
Yeah, Keith, you highlighted gold's importance in countries like India and Turkey, and of course Dubai as well. How recent economic policies in these regions strengthened or weakened the case for gold as a store of value?
I don't think anything's weakening it. I think it only gets stronger. Arguably, Turkey is not imminent hyperinflation, as it perhaps might have been a year and a half ago. But that doesn't really weaken the case for gold. It just means the crisis is in its more quiescent. The crisis has two phases in a country like that, acute and quiescent. So now it's in the quiescent phase. I don't imagine anybody in Turkey would be thinking that, oh yeah, everything's fine, sell all your gold and invest in lira. An interesting statistic that a Turkish friend and client of ours shared. Turkey has a population of about 85 million people, I believe. The banking system offers gold-denominated bank accounts in Turkey. Now, that's not a sound banking credit because the banks are forced to deposit all the gold with the central bank, who is widely believed to sell it when people are buying gold. The central bank is selling to them to reduce gold imports, which reduces pressure on the currency. These types of countries hate imports because it puts selling pressure on the currency. You have to sell the currency to buy dollars to pay for the imports. Now, if you're lending something, you don't want the borrower to just sell it. Hey, I'll lend you my car for the weekend, and you sell it. And you promise eventually you'll be able to buy my car back. Well, that's not a good plan, especially for something whose price tends to rise, unlike used cars. Anyways, there's 110 million gold-denominated bank accounts in Turkey with a population of 85 million. There was more than one gold bank account per person. So Turkey with gold bank accounts is like America with guns. It's more than one gun per person. I just find that to be an incredible statistic. Say what you will, Turkish gold demand is up, Turkish gold demand is down, and there's more gold bank accounts than there are people. There's no such thing as, oh, well, they're all going to just sell their gold and do what? They're going to buy a BRICS currency, they're going to buy lira, they're going to buy rupees. What are they going to buy? They're holding gold because that's what they do. That's how you survive in that kind of monetary regime, and nothing's going to change. It only it gets worse, but it gets worse in bursts. It's not a smooth process of getting worse. It gets really, really bad, and then it backs off just a little bit, and then it gets bad again. Who knows when it gets bad again?
Exactly. Yeah.
And tariffs could probably drive that. Tariffs will make it harder for governments, banks, and corporations to get their hands on dollars to service their dollar-denominated debt. That's going to cause all kinds of gyrations, and local currencies could go down quite a lot in the ensuing scramble for dollars.
Yeah, Keith, how are you viewing the disconnect between gold and silver, paper money versus physical?
Disconnect. I'm sorry,
Between the paper market and the physical market.
Well, there isn't. I mean, I have to kind of back up a little bit. There isn't really a disconnect. The price of a gold or silver futures contract and the price of gold or silver metal cash on the barrelhead are basically the same. I mean, if you plot both on a graph, the two lines are on top of each other. They're indistinguishable. You need a very fine precision instrument, which we call the gold basis, to see the difference between the two. But they're off by, if you measure the gold basis, which is the price of the futures market minus the price of the spot market, it's on an annualized basis. So let's say the next contract right now, here we are basically entering August, the next real contract, sort of October. October is not really that great a contract, call it December. What is that, 4 months away? Annualized, that could be 3-4%, which means the December contract would be, let's call it 1% above spot. 1% is $30. And then, by the way, that's higher. That is, people are paying more for that paper than they are for the metal. I want to emphasize that, because the theory that says they're divorcing says, oh, people are rejecting the paper, they're repudiating it. Well, the paper is $30 higher than the metal at the moment, and that's called contango. That's normal. That's what the market is supposed to look like when there is no crisis, which there is not currently in gold. And that moves around. It's largely driven by the interest rate plus fear of counterparties. When the fear of the counterparty becomes really great, you get backwardation. We don't have backwardation at the moment. There's not a lot else to say. For people who think that there's this massive short selling pressure on paper suppressing the prices of the metals, that would drive backwardation, which, as I said, is not occurring right now. I wrote what I think is the definitive proof that this is not happening, and it was a response to, I think, the last thing that Ted Butler wrote. Ted Butler said, look, I'm an old man now, I'm retiring, I've given my work to the world, here's my thesis, silver's manipulated, by selling futures, blah, 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 but I encourage thoughtful disagreement. So I wrote an article called Thoughtful Disagreement with Ted Butler, in which I stated his thesis in a way that I think he would agree. I said, okay, now, when you have two competing theories, his is that it's manipulated, mine is that the futures market is an arbitrage market, not a manipulation market. You look for a case where the two theories predict opposite outcomes, and let's find that case. And Monetary Metals, we have licensed data going back to 1996 for every futures contract in gold and silver plus spot with sub-millisecond pricing resolution. It's terabytes of data. And in that article, I don't remember what year that was, maybe 2017 or something, from 1996 to that date, 20 years or 20 some odd years, we looked at every futures contract as it went into expiry and showed that every last one of them agreed with my theory that this is an arbitrage market and behaved as an arbitrage market. And so put that out there as the definitive proof, no, this is not manipulated. Fortunately or unfortunately, it's not manipulated. It is what it is. If you think gold should be 30,000 instead of 3,000, you can buy gold on that thesis, but don't buy it because you think it would be 30,000, but for some nefarious dark cabal. That's not true. It's not going to happen. Anyways, that essay is out there. Every gold site, including the gold conspiracy ones like Le Metropole Cafe, which is Gada's own website, I believe. Or Gada as well, I should say, published it, and one of the Gada guys runs Le Metropole. Published this essay, Thoughtful Disagreement with Ted Butler. All the data is out there in that article. The argument is out there, and let people, come to their own conclusions.
Fair point. As president of the Gold Standard Institute, how are you adapting your advocacy to address the public's concerns about inflation, debt, and financial instability?
So I have to say the Gold Standard Institute, I have two efforts that I created. One is the Gold Standard Institute, which is a nonprofit 501c3 in the United States for education and outreach, and then Monetary Metals, which is a for-profit company that pays interest on customers' gold and silver. I spent years and years trying to do the education and outreach. I met, not strictly part of Gold Standard Institute, but I met many politicians, was involved at the state level in many states that ultimately did pass various legislation. I met with federal senators. I met with members of parliament in a number of countries. And I got surprisingly little traction for all the energy and time and effort that I put into it. And as an entrepreneur, traction is something you think about, and I guess you could define it as a ratio of how much output you get, based on how much input, you're putting in. And that should be not only greater than 1, but that should be growing exponentially if you're succeeding anyways. And I was getting surprisingly little traction. It was just an enormous project, a daunting project with no end, and unlimited sink for resources. So I shifted more of my energy over time, and this is going back years now, to Monetary Metals, where we're going about the same thing by appealing to people's self-interest. And there's a very funny phenomenon here. If you talk to almost anybody, even including, I call them otherwise free marketers, the people that can tell you what's wrong with a minimum wage or rent control and why these policies hurt the very people that they're allegedly designed to help. And they can talk about tariffs and they can talk about taxes and all these things. But when it comes to money, they are absolutely for central planning and having a committee of central bankers sit down and decide and dictate, what the price of credit should be. Almost everybody will go along and say, well, yes, you have to have a central bank because at that part of the business cycle, it has to be supportive of the economy. And when things get too boomy, the central bank has to take away the punch bowl. Right? They'll give you all the sort of standard party line, stuff. And they vote that way as well. I mean, some politician said, I intend to repeal the Fed. There's room for an occasional Ron Paul, but the entire rest of the entire system, if there's 535 congressmen, I think, 34 of them were against him, and he was standing alone, and God bless him for that. But the entire system is just absolutely not. And the entire economics profession, et cetera. And if you ask people, they will be for fiat money and for the central bank, and they vote that way. However, there's an interesting anomaly, which is when it comes to their own money, everyone says, well, yes, you have to debase the currency in order to prop up the economy and boost GDP and exports and jobs. When it comes to their own, I don't want to be the sucker. It's my savings that are being devalued. Well, that's for the little people. And so, it's not that hard to show them, and a lot of them are turning to gold. And for those who do, it's not that hard to show them it's better to earn interest on your gold than to pay, fees on it. And so we're changing behaviors, if not minds, one at a time by opening accounts. And when people see the amount of gold in the account going up, it's a paradigm shift that you can never get. I can write about this stuff. I can talk about this stuff until the end of time. And everyone says, yeah, I get it, Keith, I get it. But yeah, sort of not really. If I give you an account statement and you start out with 10 ounces and a year later, you have 10.7 ounces, suddenly, people get it in a way that they never would from a speech or an essay. And so, my energy now is directed not towards arguing about, monetary policy so much. Yeah, on podcasts, it's great. But 99% of my time is about just building, a client book that, benefits from this. And people, even the people who say they support monetary policy, will have gold and open an account and enjoy the benefits of it. And that's how I think, if we're going to change the world, that's how we're going to change it.
That's a pretty honest question, and I agree. Keith, how can people reach out to you?
So on Twitter, I'm at Real Keith Weiner. Perhaps more importantly, my company is monetary-metals.com. And, we pay interest on gold. And that's a really simple thing. It's easy to say. The implications of that are profound. If you want to see any kind of honest monetary system restored, it has to begin with interest. So I published, there's a book called Free Trade in the 21st Century, published by Springer. And one of the editors is Lord Daniel Hannan. I don't know if he's still an MP or former MP in the UK. And he's all about free trade and free markets. And so they have chapters contributed by quite a wide variety of, very well-known people. So I'm honored and grateful to have had a chance to contribute a chapter. And basically saying gold is that monetary system that you need. If you want free trade, it can't be based on the currency of one nation who thinks they can put their thumb on the scales, for their own advantage and to everyone else's disadvantage. It's got to be a neutral thing. I'm working on a chapter for another book now on, if you want gold or Bitcoin or whatever it is, what's the key to bringing it back as a real monetary, system? And the key is interest. If there's no interest earned on it, the only thing you can really do with it is buy it. Do nothing with it. Just lock it up, wait for its price to go up, and then sell it. Now, if that's what you want, if you just want to gain in fiat purchasing power, okay, have at it. And the central banks force you to play the game. So I say blame the blame the Fed, don't blame the players. They're forced into their game. But it doesn't do anything economic. That's not a move towards adoption. That's just speculation. Whether it be gold or Bitcoin or anything else. If you want it to be adopted and used, there's the old saying, money has functions for, what is it, a medium, a standard, a something, and a store. Anyways, if you want those functions to be, to work for gold, then there has to be interest earnable on it. And so I say to people, a good working definition of a gold standard is when anybody wants to can deposit their gold and earn interest on their gold in gold. And then as a consequence of that, because you're financing real businesses, that's how the interest is earned. Because you're financing all the real businesses in gold, as a consequence of that, everything else will happen. I mean, think of store of value. I point out to the Bitcoiners all the time, Bitcoin has two phases, and one of them is skyrocketing. And even during phase one skyrocketing, that's not a store. That's a rocket going up. And of course, there is a phase two that comes after that. And the drawdowns in Bitcoin can be, 80%. Or maybe only 50%, but 50% is still horrific. If you're the idiot who bought the top, that's quite painful. And then they always turn around, this is a fallacy known as tu coque in Latin, you too. And they always say, well, gold is volatile too. In fiat currency terms, that's volatile. But there is sort of a point that if you have a fixed, let's say, cost of living in dollars and fixed debt service in dollars, you can't use gold as a store of value, because if the gold price drops, you lose. So that's what President Roosevelt did in 1933. He made gold this risky thing, and fiat currency, if you were a conservative saver, you had to have fiat currency, and invest in government bonds. That was the most conservative thing you could do, whereas previously the most conservative thing was to own the gold. So they've stripped away even store of value. Gold is clearly not a medium of exchange today, and clearly other than monetary metals, and maybe, I've just heard of another company talking about doing this, nobody keeps their balance sheet or their books in gold. So it's not a unit. An unit of account, it's not a standard. If you want these things to come about, you have to have finance in gold and interest in gold. And so that's what we're doing, monetary-metals.com. That's my extended address.
Definitely. We will leave the link in the description of the video. Keith, I want to thank you for this educational content. Thank you for coming.
Thanks for having me.